Hey, Bigger Pockets. My name is Patrick White. This is my dad, Jamie White. We run a little property management, real estate investment business together, and we think we have a cool story to share. I hope you agree. So we're going to kind of do this format as, each other asking. We're going to ask each other the questions that you posed on the application, call it, and the other person will answer. So we're going to start with me asking the question. My dad's going to start with the bio. So Dad, tell us a little bit about the business, how it started, and kind of how you see it going.
Well, I'm going to tell you why it even happened. So Patrick was swimming in 2011 in the D1 Championship of Swimming that was held at University of Minnesota. And since I hadn't been to Minnesota for about 60 years, I thought it would be fun to go see if I could find the farm that my dad grew up on. So which I did. And that led me into kind of falling into a real estate investment business because I'd met a couple of people that owned real estate and their real estate wasn't doing super well. And along the way, I met their bankers and their bankers thought it'd be a good idea if I started acquiring some of the properties and see what would happen. So that's what happened. And now we have 19 single family houses, and because of Patrick's website, we also have a 16-unit apartment building, which we acquired in December 1st of last year.
So how did you end up acquiring these properties to begin with, Dad?
Well, as I said, I was doing some consulting for Steve, and because I was doing that, I met his bankers, and they just thought it would be maybe a good idea if I was managing / owned some of the houses. So little by little, that's what we did. I took them over, and they gave me pretty attractive financing. And in retrospect, I wish I'd done the financing a little better, but it's fine. I probably invested about $75,000 over the last 10 years, most of which was done in the early years. And as I acquired the property, a lot of the money that I invested was put into renovation of houses that had very severe deferred maintenance. And there's a lot of that in southern Minnesota, and that's what kind of helps create the business opportunity. My background is a home builder in Southern California. I built about 500 houses in the 1980s, so I have a pretty deep understanding of housing structures and how stuff is put together. And I was able to look at these houses and see their deficiencies and understand how to correct it, which is what I've done. And I kind of done that with the building department of Fairmont, and we kind of cooperate, and I talk to the inspector, and we look at a problem and decide how we can make it meet the uniform building codes as close as we can. Can't always do that, but we can come close. So
that's kind of when I joined the party a little bit, I guess. I kind of how I got involved. I had a career selling REITs over the phone. I first did it retail, then I did it wholesale for a short period of time, and it just wasn't something I wanted to continue doing. So I hooked up my wakeboard boat to my truck, and I left California in 2018, do some soul searching, and a couple of weeks into my trip, I ended up sinking my boat in Lake Powell by hitting a submerged rock. Went down in about a minute. I was lucky to have survived. I wasn't harmed, but boating's my passion, so I had to get a new boat as soon as possible. So basically what I did is I scoured the Craigslist ads nationwide, spread out my search so I could get exactly the boat I wanted, and I found it. It happened to be in southern Minnesota, about 100 miles away from where my dad was. So kind of took it as a sign. I drove up there to Minnesota, bought the boat, put it in the Mississippi River, and got to work helping my dad grow the portfolio. So kind of fast forward to today, I built a website to market our brand, market our vacancies, tracks the best tenants. We have the best tenant base we've ever had, since We've recently acquired this 16 unit apartment building, which is at a 17 and a half cap. We'll go into those numbers a little later, and have grown the portfolio to a total of 35 doors. So we have our website. It's www.midamerican.properties. If you'd like to check out a little bit more about what we've going on, it's pretty simple, but it's effective. So Dad, I think I'll let you also take the next one. Give us a quick snapshot of what the last 3 years, well, or maybe I should do that one. What do you think? Yeah, and this is, yeah, let me take this one, Dad. So the last 3 years of our real estate investing, history is, look, it's been rocky. 3 years ago, I joined my dad in his business. That time he had this 19 single family units. But he wasn't using any technology, no marketing. He would find tenants by a friend of a friend, and they wouldn't work out, those kinds of things. Didn't have lease agreements a lot of times, and he was using Excel spreadsheets, which, it's to do his accounting and pretty much everything, track everything else. And so I saw room for improvement there. As well on the first, he used to go on the first of the month collecting rents by driving around and knocking on doors. So that was a challenge that we had. So when I came, things really got off to a rocky start. We fought a lot. I was trying to change the way he'd done things for 7 years. And frankly, I didn't allocate enough effort to training him on the new technologies, the new processes that I was trying to implement, that he just, he just didn't understand. And I treated him as obsolete, told him to go home, said that I could do it better. And not much happened for a year while we fought constantly. And one day he said, you know what, Patrick, I'm done fighting with you. The business is yours. Have a blast. I'm going back to California. And he did for about 2 years. And so I basically got what I wished for. All the responsibilities fell on my shoulders, and I learned his accounting system inside and out. I worked side by side with our general contractor, our construction manager, and I helped her do some of the renovations, not a lot, but some of them. And I came to understand how the business really works. So I created a logo, started building a website, market our vacancies and our brand. And I implemented a cloud-based property management and accounting software that allows the tenants to pay online. And I started defining new operational procedures based on, inefficiencies that I saw to kind of increase inefficiency, production, and productivity. With Alyssa, our maintenance repairs, save some money. But I think the time apart was good for my dad and I. We started working together a lot better from a distance. So he took back some of his responsibilities, and we finally then, once we were separated, became real business partners, not in each other's face all the time. And then, I think both of us would agree that we hit the jackpot with this 16 unit apartment building. An inquiry actually came through our website from the owner of this apartment building. They needed a property manager. They didn't know how to deal with tenants. They were attorneys. And so they were a law firm and a holding company that had acquired the property in a foreclosure from a delinquent client, and they had no idea what to do with it. So we did know what to do with it. So when I saw that come through, I called up my dad and I said, well, what do you think? And my dad said, Jesus Christ, why don't you get on the phone and call them right now and ask if we can buy it? So we did. And the holding company was happy to oblige. They just asked for the tax assessed value of $275,000 as a purchase price. Gross rents when we bought it were $425 per month per unit, which was well below market. And expenses around just shy of 3,000, NOI just shy of 4,000 a month for a cap rate of 17.5, which we're pretty proud of. And right now we're doing minor value add maintenance to the building. There's not really a whole lot wrong with it. It's just really, kind of amazing what fell in our lap. And we've increased the rents to $550 a month, and we've gotten some verbal offers from potential buyers for upwards of $600,000 on a property we paid $275,000 for. So that's kind of the last 3 years. I think I'll let you take the next one, Dad. What does a typical deal look like for you?
Well, real estate opportunities in southern Minnesota are amazing. So I'm 81. So over my years in Southern California, I saw real estate values go up 100 times from a $6,000 house in 1950 is now $600,000. So I've always, watched the appreciation of real estate. And when I came to Southern Minnesota and saw that I could buy a house for $30,000 and rent it for $500 a month, I thought, wow, there's something here. And the more I got into it, the more I thought I was right. And that is exactly what is happening now. In the beginning, I thought that we would be able to bring investors to this Midwestern area. And now we don't really want investors. We just want to grow our business and take advantage of this opportunity. I believe that over the next 20 or 30 years, you'll see a 2 or 3 time increase in real estate values in the Midwest, Southern Minnesota, Northern Iowa region.
Awesome. Well, so the next question, what's the core message listeners would take away from your podcast episode? And you had a good, you said this one well earlier, Dad, so don't fail me.
Oh, I think that
What?
Well, I did this wrong. I just did what you.
Okay.
Got out of sync here because you have the typical deal blue.
Yeah. Okay. We'll figure this out. Okay. So I think what we've skipped over is what's the typical deal, and they ask us to go through the numbers on the deal. So if you can, I sort of did on the last one, but you can go into the numbers on the 16-plex, a little bit more detail now.
Yeah. The 16-unit building was just an amazing opportunity. In real estate, you seldom see something like this. As Patrick said, this law firm acquired the building either in a foreclosure or a bankruptcy proceeding. We're not really clear on how that happened, but anyhow, they decided to market it at what the tax assessor's valuation was, which was very low compared to from a point of net operating income point of view. So
So a little bit about the number. We had the 275,000. Building needs some maintenance, but nothing major. But each unit, we've now gotten the rents up to $550 a month. We're thinking once we actually we have some turnover, we can get those ones that we've renovated once somebody moves out up to $650 a month. We still have the same about $3,000 a month in expenses. So, it's a net operating income about $5,000 a month.
Now as we grow the income, the expenses will not grow. There's water that we pay and electricity that we pay, and that won't change as we increase the rent. So our costs will stay substantially the same, while our rents over the years will steadily go up, and that's happening all over the Midwestern area. When I first came to Minnesota 10 years ago, the rents were around $450 a month, and now the typical rent for a 2-bedroom, 1-bath is $650 to $700. And in Fairmont, Minnesota, there are virtually 0 vacancies. And that's nice, but it's also frustrating when somebody asks you, do you have a house to rent? And we go, wish we did, but we don't. They're all full and they stay full. So unusual opportunity that we have gonna get the benefit of. I can tell you experiences of sometimes I tell people, if I owned a bit of real estate in the 1970s, but in those days, oftentimes you had a negative cash flow, which wasn't comfortable for me because I was young. So, I sold it along the way. But had I gotten a job at McDonald's in 1980 and kept all that real estate, it's now worth $10 million. So I learned that lesson, and I'm not going to make that mistake in the Midwest. We're going to acquire real estate. We're going to keep it, let it mature, unless we get some spectacular offer that allows us better piece listeners can hear. There is opportunities in the middle of the country that simply do not exist on the coasts. 4.5 caps are very, very common among investment properties there. And we see 9 and 10 caps here quite often. And that's a big difference. So when we acquire a piece of real estate, we want it to be different than a 9 or 10 cap. So I have a little formula that goes, I want the monthly rent to be 1.5% of the total of the mortgage and the cash we have in the property. If that is the case, then the property makes a positive cash flow. And sometimes we'll even be able to ultimately refinance out of the property entirely. By that, I mean, whatever capital investment we made, we would be able to recover with refinancing along the way. And that will not be uncommon as appreciation occurs. So, what's the return on investment when the investment is zero? I ask that question laughingly to people because people don't know that when you divide something by zero, the answer is infinity. So that's a little bit from my engineering background. Anyhow.
So I just want to let the Bigger Pockets people know that he will have a more reliable internet connection if we are selected. He's right now we're doing a Zoom call because I'm in California for a wedding, a friend's wedding, and he's in Minnesota, taking care of business. But I'll be back there in Minnesota on Tuesday, so we can be together. We can make sure we have everything together. So anyway, Dad, I was listening to you, and it sounds like you
Patrick, I just want to make some comments about
sure
about real estate in general, and I want to emphasize it's really difficult to lose money investing in real estate. Historically, in the United States, for a long period of time, you can maybe go back 100 years. You certainly can go back to post World War II. So what's that? Almost 75, 80 years. From time to time, there's been minor decreases in real estate values, like in 2008 when we had a financial crisis in the United States. Real estate really went down, but that's because a lot of people lost their homes, and they lost their homes because they had bought homes with liar loans that they should have never gotten in the first place. Well, those houses got foreclosed on and ultimately got sold by the lenders at very low prices. And so, and as investors, some investors like gold as a hedge against inflation. I like real estate because as inflation occurs, real estate values go up, but your mortgage always stays the same. It isn't changing. Your rents go up, the values go up, your mortgage payment stays the same. And so therefore your return on capital increases. And that's why I think real estate is a better hedge than gold. There's the other little issue of real estate. When you have net operating income, that's taxable. But in real estate, you can do a depreciation and reduce the impact of that tax. So, those are the little nuances of real estate. I think that we already talked about if a rent is 1.5%, monthly rent is 1.5% of the sum of mortgage and cash, that property makes money. You before you ever get involved in negotiating the deal, you have something that's a winner right to start with. And Patrick wanted me to mention a little bit about to your listeners. If somebody wants to get involved in being a real estate investor, how difficult is that to do? Well, one of the things that I always do, no matter where I go, whether I go to the Cayman Islands or Hawaii or Denver or Salt Lake City, wherever I am, I always are looking at real estate signs on, planted in the yard of some property, and I call the broker and get an asking price idea. And if I do that 10 or 15 times, I sort of get a view of what that market is like. And then I apply my 1.5% monthly rent against what they say their asking price is. And I know whether that's a market that I need to spend time on or I can't waste my time on. And I wouldn't waste my time in Denver and Salt Lake City because their prices have just gone nuts over the last several years. And for me, you can't make a deal there anymore. But then go to the Midwest and the deals are rampant. There are still $30,000 and $40,000 houses available in northern Iowa and southern Minnesota. If you go up to what they call the Twin Cities, Minneapolis, St. Paul, prices have skyrocketed. The houses are $500,000 and $600,000. So you can go example after example after example of how attractive real estate is in the Midwest. For instance, you can buy a $450,000 or $500,000, 4,000, 5,000 square foot house on a lake in Minnesota, probably a somewhat private lake. That doesn't mean there's nobody else there, but there are not a lot of other people there. So brokers tell me that they've had a lot of customers come from California with $2 million in their pocket because they sold their house in Newport Beach or wherever, and they buy a $500,000 house in the Midwest and have $1.5 million in the bank and think they went to heaven. We cut off, Patrick. We're not talking anymore.
I'm here.
Now
I'm here.
you're back.
I'm here. Don't worry about it.
Yeah.
So that's sort of
I don't know
dynamic
if
between the two of us. I try to give him a platform to spread his knowledge through technology and the things I've learned. But he knows all the basics, and that was beautiful. Really well done. So
good.
We really hoping to hear back from you guys, and really like to be on the show. We think we have an interesting story to tell, and so I think we'll wrap it up there. Thank you guys. Thanks, Dad.
We could refine our presentation a bit too.